Welcome to Marriott MBA Today. My name is John Holbrook, and today we're fortunate to have Professor Jim Brau with us in studio. And Professor Brau is an expert in initial public offerings, or IPOs. And so today he's going to educate us a little on the whole process. Welcome.
Thanks, John.
So can you just talk a little bit about what an IPO is and why companies do IPOs?
Absolutely. Sometime during the life cycle of firms, they grow to a point where they need outside equity capital. So they go ahead and approach an investment bank typically, and the investment bank will underwrite this offering where they'll sell a piece of the company, like a piece of the pie, to outside investors for the first time. That's why it's called the initial public offering.
Right.
And then that money typically is infused into the company, and they can use it, for example, to grow their product or for further market penetration.
Excellent. So companies need additional capital, so they'll go to equity markets to raise that capital. What are some of the key steps in the IPO process?
So typically when a company reaches that point, the first thing they'll do is start shopping around for an investment bank. It's very common these days to have 2 or 3 investment banks as the lead underwriters. And they will choose typically the best bank that they can get because they want the reputational effect of being with a Goldman Sachs or a Morgan Stanley or a JP Morgan, kind of to help them and launch them into being a public company. After they've selected their investment bank, the investment bank will have its team of accountants and lawyers put together the initial prospectus. It's also called a red herring. And this is the document which is filed with the SEC. And it is the amount of information that must be disclosed so that the SEC is comfortable that the investing public has enough information to make an informed choice. Once that document is filed with the SEC, typically there's multiple amendments as they put in more and more information into this document. And while they're doing that, they go on something called the roadshow typically. So they'll go to all of the financial centers in the United States and some around the world, in fact, and try to what they call build the book. So investors are not allowed to actually buy shares at that time, but they can indicate levels of interest. And from that indication, either the original price range can be set or it's adjusted up or down, being measured by this demand. And oftentimes the goal is to oversubscribe the offer so that they know for sure, the investment banks know for sure that it will clear the market.
So in layman's terms, a roadshow is kind of like a pep rally for an IPO.
It is, but it's also a lot of information is
Right.
being put out as well because it gives the big investors the opportunity to ask the CEO, the CFO, the big players in the company specific and difficult questions to see if they can answer those questions.
So it's a really demanding process for senior management for a company that's going through an IPO.
It is, and typically those executives, it gets kind of a pain in their neck because they want to be growing the company, they want to be trying to become profitable or take advantage of the momentum that they have right now, and then they have to spend a week or 2 going around doing this dog and pony show, answering really hard questions. So typically it's not something that the executives look forward to.
Right. So this roadshow process is really an intense process, and these companies typically try and get the best bank they can because they're trying to drive that premium price. You get a premium bank, so the hope is you can get a premium for your stock. So besides raising capital, what are some reasons that a company would do an IPO?
Well, oftentimes we think that it's so that the insiders and founders can kind of cash out and take the money and run. But typically that's not the case. In a typical IPO, all of the shares that are sold, or the huge majority of them, are called primary shares, and those shares come into the company itself. So there's tons of academic theories on why companies do IPOs. That would take a lot longer than the time we have right now, but we could talk about 30 different theories and reasons and evidence on why companies do IPOs. But bottom line is they want an infusion of outside equity capital.
Excellent. So IPOs, they're heating up right now, and it's a very complicated process, and a lot of money is involved. And we're grateful that Dr. Brau could join us in studio today, and we look forward to seeing you next time on Marriott MBA Today.
Thanks, John.